Germany's new streaming rules and the battle over local content Germany is asking global streamers and local TV networks to do one simple thing: invest more in German-made content. But the response from the media industry has been anything but simple. This week, broadcasters and international streaming platforms publicly criticized new government guidelines that would require them to reinvest a portion of their German revenue back into local film and television production, calling the proposal a bitter disappointment. At the same time, producers and studios welcome the plan as a long overdue lifeline. So why is a policy designed to support local storytelling dividing the industry so sharply? And what does it reveal about the future of European media? The proposal that changed the conversation. Ahead of the Berlin International Film Festival, Germany's culture minister, Wolfram Weimer, unveiled the broad framework of a new investment policy targeting both global streaming platforms and domestic television broadcasters. According to publicly released guidelines, the plan would require companies operating in Germany to invest at least 8% of their annual net local turnover into European film and television production. For investments exceeding 12%, companies would be allowed to include non-English language films and series produced in Germany. The stated goal is straightforward: strengthen Germany's struggling production sector and ensure long-term sustainability for local creators. But the details and their implications have sparked intense debate, because this isn't just about percentages, it's about control, a shift away from the work-for-hire model. One of the most contentious aspects of the proposal involves intellectual property rights. Under the new framework, streamers would be required to share certain rights with independent producers, rather than retaining full ownership under traditional work-for-hire arrangements. This represents a structural shift in how content is financed and controlled. For producers, it could mean greater creative autonomy and long-term revenue participation. For streamers, it challenges a model that has long prioritized centralized ownership and global scalability. Industry representatives were quick to push back. Industry reaction: a bitter disappointment. Vornet, the lobby group representing German commercial broadcasters and international streaming services, issued a sharply worded response. In a public statement, the group described the government's proposal as a bitter disappointment for the media industry, arguing that it abandons the possibility of a fast, flexible, and low-bureaucracy solution. Vornet also reiterated long-standing opposition to mandatory investment quotas and rights-sharing mechanisms, labeling them outdated in a rapidly evolving digital market. From their perspective, the rules risk discouraging investment rather than encouraging it. But Germany's government sees the situation very differently. While the government believes intervention is necessary, Germany is Europe's largest television market, and, after France and the United Kingdom, the continent's third largest film market. Despite that scale, the local production industry has been under increasing pressure. According to industry observers, several factors have converged: rising production costs, inflation across labor and materials, reduced spending by global streamers on scripted local content. In recent years, major platforms have scaled back expensive prestige projects, such as Netflix's Dark or Amazon Prime Video's The Griffin, in favor of cheaper reality formats and smaller-scale dramas. While cost-efficient, this shift has left many German producers with fewer opportunities to finance ambitious projects. And that's where the government's carrot comes in: a significant increase in public funding. Alongside the mandatory investment requirements, Culture Minister Weimer proposed nearly doubling federal funding for German film production. If approved, annual government support would rise to 250 million euros, or approximately $295 million. The intent is to balance obligation with incentive, pairing private sector investment requirements with expanded public funding to stabilize the industry as a whole. Supporters argue that this combination could restore confidence and long-term planning security. How Germany compares to its neighbors. Critics of the policy often frame it as overly restrictive, but in a European context, Germany's proposal is relatively moderate. In France, for example, global streaming platforms are required to invest between 20 and 25% of their annual local turnover into French and European content. Compared to that benchmark, Germany's 8% requirement appears restrained. This comparison has strengthened the government's argument that the policy aligns with established European norms, rather than representing radical intervention. So how did Germany's production community respond? Cautious optimism from producers. While some producers had hoped for a higher mandatory investment threshold, the reaction from Germany's production sector has been largely positive. Michel Müntefering, CEO and Executive Board Representative of Production Alliance, Germany's leading production association, described the announcement as a long-awaited signal. In a statement, she emphasized that strong storytelling requires more than creativity. It requires stable conditions that allow ideas to become tangible productions. Her response reflects a broader sentiment within the production community. This policy may not be perfect, but it represents movement after years of uncertainty. Studio Babelsberg weighs in. Germany's historic Studio Babelsberg, one of Europe's most prominent production facilities, also welcomed the proposal. The studio described the agreement as a strong signal for Germany's position as an attractive production location. According to Babelsberg CEO Jörg Bachmeier, the measures provide studios, producers, and service providers with renewed confidence and long-term planning security. In an industry where projects often require years of preparation, that stability is critical. But will this actually change streamer behavior? The strategic dilemma for global platforms. For international streaming companies, Germany's new framework raises complex questions. Investing more heavily in local content may improve cultural relevance, strengthen relationships with regulators, build goodwill with domestic audiences. At the same time, sharing rights and meeting fixed investment thresholds could reduce flexibility and profit margins. Some platforms may respond by consolidating investments into fewer, larger projects. Others may focus on content that satisfies requirements while minimizing long-term exposure. The real impact will depend on how the guidelines are implemented and how strictly they are enforced. And enforcement is where things often get complicated. Implementation versus intention. At this stage, the proposal outlines principles rather than finalized legislation. Details around compliance, monitoring, and enforcement mechanisms are still under discussion. Industry stakeholders on both sides have emphasized the importance of clarity. Without clear rules, uncertainty could discourage the very investment the policy aims to stimulate. The coming months, especially discussions surrounding the Berlinale, will be critical in shaping the final form of the regulations. A broader European trend, Germany's move fits into a wider European effort to rebalance power between global platforms and local creative industries. Across the continent, governments are grappling with how to preserve cultural diversity, support domestic talent, compete in a globalized content economy. Mandatory investment schemes are one of the tools being tested, not without resistance, but with growing frequency. So what's really at stake here? More than money. While headlines focus on percentages and funding totals, the deeper issue is cultural sustainability. If local production ecosystems weaken, countries risk becoming mere consumption markets rather than centers of creation. Germany's proposal seeks to prevent that outcome, even if it means friction with powerful industry players. From this perspective, the conflict isn't about punishment, it's about preservation, a controlled tonal shift. Notably, both sides claim to support local storytelling. The disagreement lies in how responsibility for that support should be distributed and who should bear the cost. Streamers argue for market-driven solutions. Producers and policymakers argue for structural guarantees. Neither position is inherently extreme, but they reflect different priorities. Which raises one final question. Germany's new investment requirements represent a careful attempt to rebalance an industry under strain, combining obligation with incentive and regulation with support. Whether the policy succeeds will depend less on rhetoric and more on execution. Can the rules encourage meaningful local production without stifling innovation? Can global platforms adapt without disengaging? As the debate continues, one thing is clear. The future of European storytelling is no longer just a creative question. It's a structural one. In the next video, we'll examine how similar investment rules have played out in other European markets and what Germany can learn from their outcomes.